Hello and welcome into the KE Report. Chad and Corey here, getting an update from Sean Brodrick, editor at Weiss Ratings Daily, and also Wealth Megatrends. We'd like to talk with you, Sean, about the megatrends that we're seeing in the markets. And right now, that trend is down in almost everything. When you look at the US equities, they were overdue for a correction. We were talking off mic about some of the pressure we've seen kind of needing to happen in a healthy way, but there is a lot of panic in the financial media and from investors right now, Sean, because they're seeing red on the screen. How are you looking at it, I guess, in the short term and then from a bigger picture, this pullback we're seeing?
Yeah, I have a column coming out at the Weiss Ratings Daily, our free easing, on Wednesday, where I talk about a bunch of the stuff, things I've already talked about with my subscribers. I'm not that concerned about it. If people want to put on protection, that's not a bad thing to do, but I am not rushing to sell anything. I mean, what we saw basically was a global margin call for hedge funds. A lot of this has to do with Japan because people tend to borrow in Japan because it's cheap there, but that situation changed. And so they had to sell, and they had to sell everything: value, high yield, big tech. Really doesn't matter. I mean, US treasuries went up, but that's about it. Oh, and also the Swiss franc. But everything else got sold. So, but if you think the US markets have it bad, I mean, Japan's stock market fell more than 25% in 3 days. I can't remember a huge decline that fast in a global market before. So obviously there's stress in the market. I'm not denying that at all. But that said, I mean, pullbacks are a part and parcel of any market. We have, on average, this is an average, folks. So you apply that with the good and the bad. But on average, we see pullbacks of 5% in stock markets 3 times a year. On average, there's a 10% pullback once per year. And then 15% pullbacks occur every other year, and 20% pullbacks occur about every 3 to 4 years. So we are having an overdue correction. Yes, absolutely. And I can give you a bunch of reasons why, at least why I think it's happening. Now, I came up with this list because I was driving from West Palm Beach to Tampa and back because my daughter was getting her graduate degree in microbiology and I had time to think. But the things on my mind: tech weakness, because AI is not delivering the return on investment that many of the big funds hope for. Now, we were heavily invested in big tech stocks in Supercycle Investor. We just took a bunch of triple digit gains. We did this recently. We took Nvidia, we took Amazon, we took some others. And just because those stocks looked toppy and they had earnings coming out. And so maybe things could have surprised to the upside. I was disappointed for a day after Nvidia announced and they went up. But after that, it's been all down. So I actually am thanking my lucky stars I did that. That doesn't mean that the tech bull market is over. No bull market goes in a straight line. Of course, things are going to go up and down. You're going to have pullbacks, you're going to have corrections, you're going to have base building. So I think the current market view on AI is short sighted, that there will be AI advances and savings and advantages, but they won't be right away. That's all. It's just that the market can't really think beyond the next quarter. So you can see why they did that. That's not the only problem, though. Earnings estimates for the next quarter are coming down. Now, we're having solid earnings growth this quarter, 11.5% last time I checked. That's the best since the fourth quarter of 2021. But the market's always pricing in the future, and they're looking at single-digit earnings growth for the S&P 500 companies next quarter, and more S&P 500 companies have warned about earnings next quarter than have upwardly revised earnings for next quarter. So the market's starting to think that we're going to have a bit of a bump. And so what does it do? Because the market always prices in the future. We're seeing some profit taking ahead of that as well. Then we have to get to political uncertainty. After the presidential debate, the market was really starting to price in a Trump victory. Now things are about even, and that's very uncertain. We don't know what policies will be in place a little over 5 months from now. For an investor who's trying to make any kind of longer term plans, that's actually quite disconcerting. And until we know, that uncertainty could really weigh on the market. And then we have the fear of recession. I mean, this is according to a recent CNBC survey, but you hear this all over the place. 2/3 of Americans believe the country is either already in a recession or fast approaching one. Now, the data does not support that. We have seen weakness, but nothing like a recession. Nonetheless, if people think that we're either in a recession or one's coming fast, that changes their behavior. And one of the things they do is they're going to take gains because they want to raise cash. Who can blame them? If that's what they believe and they're sincerely acting on their beliefs, then I have no problem with that whatsoever. I think they're wrong, but that's okay. Finally, the Fed is behind the curve. Everybody but the Fed agrees to this. And the Fed is being so obnoxiously stubborn about this, it is driving a lot of us bananas. We have had weakening economic news, not recessionary, but weakening. We've seen gloomy consumer expectations, weak new orders, negative interest rate spreads. We saw rising jobless claims, which seemed to trigger everything on like Friday. It wasn't that bad, but they rose. So the Fed is supposed to cut interest rates to balance a weakening economy. They had that opportunity in July when there was plenty of signs of weakening. They decided not to. The Fed is behind the curve. They never miss the opportunity to let the horse out of the barn before they close the door. So what the market is pricing in now is that the Fed will cut in September and then keep cutting at every meeting on into at least the first quarter of next year. So rate cuts are coming, but will it be enough to actually soothe what's going on in the market? I don't know. I do know that people who sell right after a big market drawdown really regret it. That's about the worst thing you can do in the market. What you should have done, the only way, by the way, to beat a buy and hold strategy is to take big gains before the big drawdown. Now, that's what we did in Super Cycle Investor. We were a bit lucky in that. We also did that in Wealth Megatrends, the monthly newsletter. Again, I would like to say that's all my skill, but there is some luck. And so that worked out. But selling after big drawdown is usually a path to disappointment. The only reason I would sell, and this is something that I'm doing right now, is to look closely at the recommended portfolios and see if some of these stocks no longer make sense. They just aren't going to work out in the future. So the better thing would be to sell them and take that money and put it into something I think will work better with falling interest rates, because we know pretty sure that's going to happen too. And then you should be making a shopping list. Everyone should be doing that. And then, just sit tight. I know that's a hard thing for anyone to do. Sometimes sitting is the smartest thing you can do in a market. And so if you're not sure what to do in this situation, looking at your own portfolio, stuff like that, sit tight. Longer term, you probably won't regret that. That would just be my recommendation to anyone. I mean, now I'm just one person speaking. I'm not your financial advisor, but I've been in the markets a long time, and I can tell you what has worked before. And all of that has worked before.
Sean, that's a very level-headed take on this whole market correction for how worried a lot of people were yesterday. Also, congratulations very much to your daughter for graduating with her graduate degree. The question then is, Sean, if everyone should just take a little break, see where this correction plays out, see how low these markets go, where are the opportunities? Do you look in these sectors that haven't bounced? Do you look in these sectors that correct the most? What do you look for in terms of markets to move, rotate some of that money into?
Right. And I can tell you one thing that I'm looking at is I know that one industry is already in a recession, and that's real estate, home building also, stuff like that. Those have been hammered by these higher rates. So if rates are going to go down, then you'll definitely want to own some of those stocks. Now, I have been buying, just nibbling really, and probably a little too early. To be honest, it just hasn't really worked out yet, right? Especially after that big 3-day sell-off. But nonetheless, I think that's where we're going to see some good returns, if not in the next quarter, then the quarter after. Now, what I like, and I have access to a Bloomberg terminal, so it makes it easier for me, but I like companies that are in financial turnaround. They've had a bad few quarters, maybe a bad year. And so things have not been going well, but going forward, their earnings estimates are rising. People think that they've hit that cyclical low in the business. Things will improve for them going forward. You can find that with a lot of home builders and real estate companies now. just because they were in a really tough spot and things are going to get better for them. So they might not be making money now, but they are going to make it in the future. And so if you're looking for anything that's undervalued, that's one thing that, can be undervalued. Also, I think some of the selling in tech is just reaching absurd levels. I mean, Amazon should not be sold this way. I can completely understand, and it wouldn't surprise me to see it go lower. But it's a bargain right now. We've owned it before. We made some nice money on it. I can tell you we're going to buy that again. Something like, say, Taiwan Semiconductor. Well, you know what? The world's still going to need its chips. Now, there was an interesting development, which is some of NVIDIA's customers said that they're going to rethink how many chips they're buying. They're still going to buy chips, but maybe they don't need to buy as many chips. Maybe they don't need to roll out AI as quickly as they were. That could impact NVIDIA, and that could impact Taiwan Semiconductor as well, because they make the chips for NVIDIA and stuff. But on the other hand, we're still going to need chips, so that market is not going away. When things bottom, then you might want to look at them and see if those would work in your portfolio. I can think of other things as well. There are companies, very few companies are actually using artificial intelligence right now. I saw some stat last week. I think it said only 5% of companies in the S&P 500 are actually using artificial intelligence. That's a huge upside market. The chance of that growing in there is actually quite large. Artificial intelligence will come into play. It will transform some industries, not all of them, maybe not even half of them, but some. So if you can pick those winners, though, then that's a real opportunity there. And then we can get to commodities. I thought we were in a commodity super cycle. The last couple of weeks has been slapping me in the face, isn't it? But you know what? If we're looking at economic growth continuing, then we are going to need more commodities and things will ramp up quite nicely. And I had to say, my oil stocks, despite the pullbacks we've seen, they're still some of the best performers we have because of all the cash that they make. They are cash flow machines, especially at recent prices. So, I would not say you should be buying hand over fist. I think sitting tight for a while and just judging and seeing what's going on is a good way to approach this. But for Pete's sake, make your shopping list, what you want to buy when the time is right. And you won't be sorry that way.
Yeah, great point, Sean. Everybody should have their watch list and their shopping list for when there are sell-offs that they can take advantage of it. And of course, they need a little cash on the sidelines to do so. But just following up on something you said about the real estate market, we don't talk about that as often on the show, but one of the things that people have noted is that, home builders, kind of a mixed bag depending on which one you look at. But if you look at REITs, where there's a real estate investment trust, and it's a collection of different real estate assets, a lot of those have been ripping higher all year long and have still been ripping higher, kind of ahead of the real estate market. It's more like having a royalty company in the precious metals or base metal side because you got these collection of different real estate assets. How do you feel about the REIT sector?
That is an interesting way to look at REITs. I hadn't thought of looking at REITs as a royalty company. But you know what? That's not a bad analogy to draw there. I like that, Chad. That's well, in fact, I am looking at a REIT right now, which actually had a great year, but got hammered during this recent pullback. So maybe it's time to buy it. We'll have to see how things go. Also, depending on how you think the election goes. And honestly, I don't know who's going to win. I don't think anyone does. But if you want to start placing your bets, cannabis companies will probably do pretty well if the Democrats win. We do know that Chuck Schumer is the slowest walking human being who's ever been in the Senate, and he's been promising cannabis reform for years now. It's absolutely maddening, but nonetheless, things are coming together, and we could see a real legalization move in the next Congress if the Democrats win. Now, if Trump's in the White House and the Democrats win anyway, I don't see why he'd oppose it, but maybe he would. So maybe things wouldn't be so good that way. As for what if Trump gets in and he gets a Republican majority in the House and the Senate, well, we know what he's going to do, which he's going to cut taxes on corporations, and he's also going to cut taxes on high net worth individuals. I think that's part of what we saw in the sell-off is because I'm not saying that his chances are bad, but his chances became about maybe 50-50. We saw some people pull back because they had exuberance thinking they were going to get a big tax cut. Now they're not sure if they're going to get a big tax cut. But things that do well, like say luxury stocks, when like wealthy individuals have lots of money, that might be a thing you want to look at for a Trump victory. So, you can play that whichever way you want, or you can just get back to what I said earlier and just sit and wait and watch things for a little while. We have a little over 3 months to the election, and after that, we'll have a lot more resolution on what's actually going on.
Yeah, that political uncertainty, like you said, 3 more months of that. The one thing that is certain are rate cuts, though. Lower interest rates, they might not come as quickly as some market participants think, such as 50, 75, even 100 basis points out of the gate. But we will, I think we can confidently say, see lower interest rates by the end of the year and continue through next year. What are the no-brainer trades in that there, Sean?
Well, I think I touched on some, which is home builders. Those should do well. Also, we'll probably see car sales go higher, right? I mean, so there are listed auto dealerships. Maybe you want to look at those. Those are two things where high rates have really been a problem, and rates will go down. By the way, I've been seeing some otherwise smart people call for an intermeeting rate cut. They think that this sell-off was so bad that the Fed's going to cut in August, even though it has no meeting scheduled in August. I don't think that's happening. That would be panic, and the Fed doesn't like to look like it's panicking. It also doesn't like to look wrong, and it's obviously wrong, but looking like it's panicking would be even worse. So don't expect them to panic. Don't expect an intra-meeting rate cut this month. That's probably not going to happen.
Yeah, good point. A lot of people are panicking themselves, and so they want the Fed to step in and do something immediately, but the Fed would be sending a completely wrong signal if they jumped in and did what some people are proposing, a 75 basis point hike. That just seems a bit extreme, considering there's only been a couple down days in the market. But when you look at the commodity sector, it's a mixed bag. You mentioned the energy stocks were holding up well. And energy is a really weird one, Sean, just because with all the tension in the Middle East, you mentioned geopolitics as a factor. A lot of people would have thought that would have spiked the punch bowl in oil. There's a lot of forces that are driving the oil markets, but how are you looking at energy? And let's also weave nat gas into that discussion.
Yeah, well, I never trade on news out of the Middle East because news out of the Middle East comes and goes, and I think sometimes people over there rattle the sabers just to get prices moving, frankly, and does that mean that Iran won't attack Israel? No, I mean, the way things are going, we could see an attack by Iran on Israel, and then Israel might retaliate. And so, yeah, I can see people doing that, but at some point it'll all end and then the prices will come back down. So I actually like the global growth story for both oil and natural gas. And also, I saw some news stories recently. I'd have to go look those up again, where natural gas is really being pushed as a coal replacement now because they can't build nuclear power plants fast enough. And they're just trying to get rid of the coal dust that's choking everybody. And nat gas is just so much cleaner. It isn't a green fuel, but for example, I think people who are trying to get rid of natural gas stoves are just idiots because it's actually much more efficient to use a natural gas stove than to use an electric stove. Why? Because in most cases, that electricity you're going to use for an electric stove has to be made at a power plant that's either fueled by natural gas or coal or something else. So it has to go through the inefficiency of making electricity at the plant and then traveling through the power lines and coming to your house and then actually making the electricity for you to cook. Whereas if you cook straight from natural gas, it's much more efficient. So that's actually much greener. So there's a lot of bad ideas out there. And like getting rid of natural gas stoves is one of them. But I'm not obsessing on it like some people are. We'll see how things go. I am quite pro green as in building nuclear power plants, solar power, wind. Let's have more of all of it. It's all green, really. You're just trying to get rid of that stinking coal dust. That's all there is to it. So natural gas is down low. I mean, let's face it. It has not had a good time. It's right above $2 is like you and I talk. Now, does this mean we'll have a big rally? The way things looked at the beginning of the summer, there was supposed to be a big rally and it didn't happen. So I'm not going to predict a natural gas rally. Then again, I have companies in the portfolio that are, let's say, natural gas focused, and they're actually doing pretty well because of where they are in the food chain. So not all natural gas stocks will be alike, and some of them can actually do quite well under the circumstances. So I like that. Crude oil, well, we just saw the White House just made another buy for the Strategic Petroleum Reserve. That's just a drop in the bucket, and I realize that, but it just shows that they make the kind of actions that are supportive of the price of oil. And so the best cure for low oil prices is, of course, low oil prices. That's what we have now. Gas prices across the country are cheaper than they were a year ago. So it just makes it more likely that the price is going to go up. Even if you just think it's in a big range, it's near the bottom of that range. It's probably going higher. The only thing that would derail that is a global recession. And right now, I just do not see one. Other people have other views on this. Other people think the US is in recession. I think they're wrong. I think that, with the exception of a few industries, things are actually trucking along pretty well. But everyone has their own view on this.
You know what? A lot of people are looking to a recession now, maybe at the beginning of next year. And to your point, the oil market, it's been relatively boring for a year and a half now. Natural gas, that's also been stuck. What about uranium, though? We talk a lot about uranium with you, and uranium was doing really well. And now you look at something like URA, that's off about 30% from its earlier highs, still at a generally higher level when you go back to really any time prior than 2022 or 2021. But what's your outlook for uranium from this level?
What a disappointment. I'm telling you, if uranium did what I thought it would do, I'd be rich by now. I mean, we had news out of Kazakhstan that they were increasing production slightly, by the slightest amount. And all the uranium they were going to produce with that was going to rebuilding their stockpiles, which are low. And that was enough to trigger this like screaming sell-off in all kinds of uranium stocks. It's absolutely ridiculous. It makes no sense. We heard from Cameco that long-term contract prices are being negotiated higher, which is really where most of the money is made. And from these miners anyway, they have to get contracts. So sometimes the market makes no sense, but as the old saying goes, the market can remain irrational longer than you can remain solvent. I'm still bullish uranium longer term. This has been a short-term dip, and if I wasn't so beaten up, I'd probably be putting more money to work in the uranium space right now. But right now, I'm just trying to sit tight and actually see things through, see what's actually happening with the market, because even though I think prices are really low, I mean, rock bottom low in the uranium industry right now, they can go lower, right? And so I do not want to catch that falling knife. I want to wait for prices to turn higher. That's when I'll start buying again. But right now, it's just extremely disappointing, especially considering what the fundamentals are. The news out of Kazakhstan was not bearish. It is just they are producing a little more and they're putting it in their own stockpiles. They also mentioned, by the way, that they can't get enough sulfuric acid. And actually, production at one of their mines is going down because they can't get enough sulfuric acid. And also, they have that new tax that they have to deal with over there, which is going to limit development and expansion of uranium mines over there. That's just obvious. So I don't understand this market. It has been disappointing to me. It smacked me in the face. That's okay. I'm a big boy. I can deal with that. And I think there are higher uranium prices in the future.
Well, Sean, I appreciate you breaking that down for us on the uranium markets and the energy markets. And yeah, I mean, I think people have to remember that just in May, which was only a couple months ago, URNM, the Sprott Funds Uranium Mining ETF, was at all-time highs. And it was just at all-time highs in January and February before that. So while it has rolled over hard the last couple months, that's coming off all-time highs and after a 4-year blistering rally. So I think the uranium sector still longer term has all those fundamental factors you just outlined for us in its favor. And I think the market just overreacted to the Kazakhstan news on the slight increase in production on days where the whole market was selling off in the red in sympathy. So it's one of those opportunities that investors can be looking at to scale into positions if they haven't already gotten positioned. And I appreciate getting your outlook on the broad markets and how you're looking at things as far as some of the mega trends you're seeing in tech, some of the things you're seeing with home builders, and we'll just keep following along with the macro news. If people want to follow along with Sean's thoughts, definitely click on the link below this interview. It takes you over to his link at Weiss Ratings Daily and also his link over to Wealth Megatrends. And we also will put a link to Resource Trader, where Sean gets into some of the mining stocks he invests in, and that's pretty relevant to our audience here at the KE Report. Looking forward to our next conversation, Sean.
Oh, thanks, guys. It's always a pleasure.